If you're a tax professional, a CA student, or you run your own business in India, you know a major shift is on the horizon. The Income Tax Act 2025 is here to modernize our tax code, and today we're jumping right into one of the most critical chapters, profits and gains of business or profession, or PGPB as we all know it. Let's break down exactly what you need to know.
So, the real question on everyone's mind is this, right? How does this new act actually change the game for calculating business income and handling all the compliance that comes with it? Look, it's not just about a few new section numbers. It's really a fundamental move towards making things simpler and clearer. So let's answer that piece by piece.
All right, here's our roadmap. We'll kick things off with the new PGB framework, then we'll look at how business income is actually charged. After that, we'll do a deep dive into deductions, using scientific research as a really good example. We'll also unpack the simplified presumptive tax schemes, before we wrap everything up with accounts, audits, and of course, the most important takeaways. First up, let's get a handle on the foundational shift in the PGB framework. You know, the main goal of the 2025 Act is to streamline and simplify, and that starts with the very words we use. Okay, so probably one of the best changes, something we've all been waiting for, is getting rid of the whole previous year and assessment year confusion, right? The new act just wipes that away and gives us one single, easy term: tax year. That's it. So the year you earn the income is the same year it's assessed. Think about it. Income from the financial year 2026-27, it's just taxed in, you guessed it, tax year 2026-27. It sounds like a small tweak, but honestly, it's a huge leap in making things simpler for everyone. So how does this new, simpler approach apply to the very heart of PGBP? Let's take a look at the charging section. This is what makes business income taxable under the new law. The main charging provision is moving from the old Section 28 to the new Section 26. Now, while the core idea of taxing business profits is exactly the same, this isn't just a renumbering exercise. The new Section 26 has been written with so much more clarity, and that's on purpose. It's designed to cut down on all those interpretational arguments that were so common under the old Act. To really get the practical impact of the new Act, let's zoom in on one specific area: deductions for spending on scientific research. This is all now governed by Section 45. This quote from Section 45 really shows the government is still serious about encouraging innovation. The good news is the valuable deductions for scientific research are staying. But the new act brings in a much more structured and transparent way to handle compliance. This is especially true for sponsored R&D programs, where the whole point is to make sure everything is above board. So this new compliance process, which is laid out in the 2026 tax rules, is all about creating a clear digital paper trail. You see it here. From the first application in Form 7 all the way to the final annual report in Form 10, every single step is documented. The biggest benefit? Total transparency. For the taxpayer, it's solid proof of their contribution, and for the tax department, it creates a perfect digital audit trail, which means less ambiguity and fewer disputes down the road. Of course, the Act also takes care of businesses that are doing their own research. Section 45, subsection 2, gives parallel deductions for both capital and revenue spending on approved in-house R&D facilities. This makes sure that innovation happening right inside a company is also rewarded. All right, now if you're dealing with in-house R&D claims, you need to circle this one in red. Form 13. This is your go-to compliance document. You can kind of think of it as the final checkpoint. It's an audit report, has to be certified by an accountant, and it basically gives that independent stamp of approval that the accounts are clean and the spending is legit. Honestly, this is going to be the most critical piece of paper you'll need to back up any deduction claim under Section 45 too. Okay, let's switch gears and talk about something that affects millions of small businesses and professionals: presumptive taxation. And if there's one word that sums up the changes here, it's simplification. This is a massive improvement. Seriously, no more jumping between different sections for different presumptive schemes. The 2025 Act takes them all and puts them under one roof, the new Section 58. Such a simple change, but it makes the law so much easier to understand and navigate, especially for smaller taxpayers. And this table here shows you exactly how that works. All those schemes we know so well for small businesses, professionals, and goods carriage operators that used to be under Sections 44AD, 44ADA, and 44AE, well, they're all now neatly tucked into the new Section 58. It means you've got a single point of reference for all the major presumptive tax schemes. It just makes sense. Right, on to the final piece of our puzzle, the rules about maintaining books of account and getting a tax audit.
Now, this is one area where we all want continuity, and the new act definitely delivers on that front. Now, here's some really good news. A bit of a relief, actually, for both professionals and clients. That whole requirement for maintaining books of accounts, it's now under Section 62. But, and this is the key part, the thresholds haven't changed one bit. They are staying the same. So, if income goes over 1.2 lakh rupees or turnover tops 10 lakhs, the rules are exactly what you're used to. This is a huge deal because it provides stability. You don't have to scramble and completely change your accounting systems overnight. And it's a similar story for tax audits. Section 63 of the new act takes over from Section 44AB, but the core thresholds are being carried forward. The business turnover limit is still at 1 crore rupees, or, that 10 crore limit if your cash transactions are low, and the professional receipts limit stays put at 50 lakh rupees. This consistency is going to make the transition so much smoother for both taxpayers and us auditors. And here is a very practical detail you'll want to flag right away. The tax audit report, which we all know from Forms 3CA, 3CB, and 3CD, is being consolidated. From now on, it will be furnished in a single unified Form number 26. This is a crucial little update for your internal systems and all your compliance checklists. Okay, we've covered a lot of ground here, so let's boil it all down to the most important points that you really need to remember as you start navigating these new PGBP provisions. So let's recap the 4 biggest takeaways. First, start using the term tax year. It's just simpler. Second, get comfortable with the new structured compliance for deductions, like the form series we saw for R&D. Third, just remember, Section 58 is your new one-stop shop for presumptive taxation. And finally, you can breathe easy knowing that the thresholds for accounts and audits are stable, which makes this whole transition a lot less painful. And that brings us to the final and most critical question. With the very first tax year under this new act, that's 2026-27, just around the corner, it's time to ask yourself, are my internal systems, my client advisories, and my own professional knowledge ready for these changes? Thank you so much for joining me for this deep dive into the new PGBP framework. I really hope this helps you get prepared for what's coming. If you found this explainer useful, please do me a favor and like, subscribe, and of course, share it with your colleagues and your network. And just a quick final reminder, our standard disclaimer, this content is purely for educational purposes. Tax laws are always subject to change, so please always consult a professional for advice that's tailored to your unique situation.